It's time to talk about taxes. Just like that. The most famous tax is the federal income tax, but in the history of the country, it's not been around the whole time. Only been about half the time. Used periodically during the Civil War. Originally, the federal government funded itself with tariffs, that is, taxes on imports. The federal government was much smaller. The country was much smaller. The tariffs were a lot bigger back then. But anyway, the 16th constitutional amendment, which was passed in 1909 and ratified in 1913, created the federal income tax. And here, your side of the screen is the amendment that was passed. The next biggest component of federal taxes are what we call payroll taxes. So you get this on your wages. This is not a tax on all income like the individual income tax. This is just a tax on earned wages. It's how we fund Social Security, 12.4%, and also Medicare, that is the medical insurance for the elderly, at 2.9%. The total is 15%. Now, some of you might be thinking, I'm not paying 15% in payroll taxes. You're not seeing it on your pay stub. Because half of it is paid by your employer and the other half is paid by you. So on your pay stub, you see around 7.5%, more or less. But we find you do end up paying it, economically speaking, because your market wages end up being a little lower due to what the employer tax becomes. And here is all of the federal revenue. The individual income tax, a little over $2 trillion, is around 43%. Payroll tax is 32%. So these are the two biggest ones. Now, the income tax gets more attention. People talk about it more. People seem to be more aware of it. But the payroll tax, the one that you pay with your pay stubs, that's huge, $1.6 trillion. And the thing is, like, everybody pays it. Whereas not everybody pays an income tax. Especially the lower incomes don't pay any federal income tax, but everybody pays a payroll tax. And when you get your taxes back in April, that's an individual income tax rebate. It's not a payroll tax rebate. Corporate taxes are 8% of federal revenue, and then we have other types of taxes and fees and things and charges. And then excise taxes are $76 billion. Not a big chunk of what's going on. But again, I just got to keep you in mind, I can't say it enough, the individual income tax accounts for less than half of federal revenues. It's the biggest, but it's still less than half. Payroll is the underappreciated tax pony that we're all paying. In fact, we can really see how important the payroll tax is that most people actually end up paying more in payroll taxes than they do in income taxes. This particular graph on the vertical axis says the percentage of taxpayers with greater payroll tax than income taxes. This is in 2019. And on each column along the horizontal axis represent different income groups. And as we see, for most of the middle class, they're paying more in payroll tax. Each little income chunk is around 70% of those taxpayers are paying more in payroll taxes. We don't see a decline until around the $200,000 level. And of course, up here at the top, those are the people who are paying a lot more in income taxes. And they're not earning as much via standard wages, but rather through other payment packages and capital income. Payroll taxes are how we fund Social Security, and we got to talk about it. Number one, Social Security is a flat tax. Everybody pays the same percent of their income, regardless of whether they're rich or poor. It is that particular percent no matter what. Until, and this is the thing also, underappreciated, and probably there's some room for reform here. You pay Social Security tax only for your first $168,000. After that, you don't pay, you pay zero marginal Social Security tax. Doesn't mean you pay zero. You are going to pay Social Security tax, but you're only going to pay it for your first $168,000. And of course, if you're married, it's double that. Here's the thing with Social Security and why people are talking about it. There is a need for change. We have an aging population. This particular graph shows us that in 1963, there were 4 workers for every person who was on old age Social Security benefits. Today, that number is less than 3. It's projected to fall closer to 2 over the next few decades. This means the current system needs to be modified, and we can do this through a number of ways. One, we can raise the taxes so we can bring more funds to this, or we can cut benefits. And we have to have this conversation relatively soon. This is a graph showing how much savings the Social Security trust funds have. I want you to pay attention to the light blue one. That's the one we're worried about. That is the old age and survivors insurance. Right now, there's plenty of money in it, trillions of dollars worth. The projection is we are drawing more out of it than we are putting back in, and by around 2033, more or less, it will run out. So, how do we solve this? It's totally solvable. In fact, historically, we've constantly had to make adjustments to it. Social Security's been around since the 1930s. It's a 90-year-old program. It's very popular. So there's ways to address this. Number one, we can begin taxing rich wage income. So remember, after $160,000, you pay zero. What if we just had it flat tax across the board? That will help, but it won't solve it. Maybe if we did this 15 years ago or 20 years ago, it would have done it, but it's not enough. We're going to have to do more. So we could target Social Security. So if you're very wealthy, you don't need the benefits, so you don't get the benefits. That could help. The other one is to raise the retirement age. So the debate here centers on the question of, should we solve Social Security by having the people most afford to pay for it do it, either through less benefits or through more taxes? Or should we have the cuts be across the board, regardless of who is able to pay for it more or not? That would be raising the age for everybody. But regardless, the debate is on. Now I want to talk about income taxes and how they work. First, the income tax changes depending on your income level. The higher your income, the higher the marginal tax rate. Now keep that in mind. The word marginal is relatively poorly understood. This means for your first $11,000 of taxable income, you are taxed at 10%. And at the bottom of that table, you are only taxed at 37% for the money above $578,000 a year. Again, it's more of that if you're a couple. These are for an individual. Let's go through an example to cement this in. We're going to assume you're doing well. You're making $112,600 a year. We're going to apply the standard deduction. Standard deduction right now is around $14,000. This means everybody gets it. Your first $14,000 go tax-free. Nobody's paying a dime on that. Only start paying taxes after you apply that. That means $112,600 minus $14,600 is equal to $98,000. That's your taxable income. Your first $11,000 is taxed at 10% right here, right there. The equivalent of $110. Your next chunk, that is from $44,725 to $11,000, or that $33,000 there, that component is taxed at 12% for $4,047. And the next component from 95 to 44, that $50,650 is taxed at 22%. The marginal tax rate is growing. Now we're paying $11,000 of that $50,000 in a tax. That's 22% of $50,000. Now the last one, and I kind of got to shrink myself down a little bit, is from $98,000 to $95,375, or that $2,626. Only that chunk is taxed at 24% for $630. Now we add it all up. So each component gets added up. Total taxes of $15,930. That's how much we pay. Now, there's two ways people talk about this. They kind of conflate the two, and they're entirely different concepts, and you need to know the difference. So that's why we're doing this. What's your top marginal tax rate? The highest tax rate that you are subject to? Well, it'd be 24%, right? But it's only like $2,600 is subject to 24%. Most of your income is not. Remember, you're making $112,000 a year, and only $2,600 of that is subject to 24%. So what people mostly are worried about, what really matters at the end of the day, is your average tax rate. Is your average tax rate 24%? No. Remember, your standard deduction, 0. Your first $11,000 of taxable income, 10%. That's the word marginal. The word marginal means the next component. So let's get the average. Let's take our total tax of $15,000 divided by our total income, and we get an average tax rate of 14%. So on average, you're paying 14%, even though your top marginal is 24%. So know the difference. Let's say you're earning $600,000 a year. You're only paying 37% on the additional money. Everybody gets the standard deduction or better. 0% marginal tax on your first $14,000. There's a link up at the top in the other corner if you want to look at the tax brackets today, because they modify every year according to inflation. All right, that's the federal level. Let's talk about state and local revenues. We need some vocabulary. Sales tax. You buy $50 worth of clothes, you have to pay a certain percent of that $50. Excise tax. It's a flat fee based off of quantity. It's also like a consumption tax. It's similar to a sales tax, except it's calculated a little differently. We do this just for a handful of goods. Like it's sometimes called a sin tax because these are things we're trying to have less of. Gasoline, alcohol, and cigarette taxes are some of the most famous. I have down here the Washington State gasoline tax. The state has 49.4 cents per gallon, and then the feds have 18.4 cents per gallon. And so overall, if you pump up in the state of Washington, you're paying 67 or rounded up to 68 cents per gallon to the government. Now, they use that money to help build the roads and things like that. So generally, economists are in favor of this. A lot of debates are going to head into the future as we head into more electric vehicles. We'll probably have to modify how we collect the funds to pay for our roads. But this is nice too. Like if you have a big semi truck that's putting a lot of wear and tear on the road, they're also going to buy a lot of fuel, and therefore they're going to pay more taxes. So they use the roads more, and they pay more taxes to fund the roads that they use. Finally, property taxes. That's the other kind of big component here. Property taxes. This is like a real estate tax. Most of this goes to the local government, the county, and the municipal governments to help fund their things there. It's also kind of interesting because it's a wealth tax. It's one of the only wealth taxes we have, and it's a big component. How big? Here's the next slide. So property taxes are 30%. State and local governments. We're all collectively together paying $630 billion. Sales taxes, 33%, and 26% are state individual income taxes. So this is different than the federal income tax we were talking about before. Every state has totally different rules on this, but overall in the country, 26% of the revenues for state and local governments comes from individual income taxes. Corporate taxes, again, they're there, not huge, but they're certainly there. And of course, other types of taxes. I think the excise taxes go there, but if you go to like a state park and pay a fee, that'll show up in the other. The interesting thing about state individual income taxes is there's a huge variety based upon the state. Now, I've lived in 3 states in my life, Washington, Nevada, and Texas, and I've never had to pay a state income tax. There are a total of 7, so Wyoming, South Dakota, Florida, and Alaska are the other ones. And then some states like New Hampshire and Tennessee, and even North Dakota, have a very small state income tax. And then other states like Oregon, 42% of their revenues come from income taxes. Now, the trick about Oregon is they don't have a sales tax. So the trick is, live in Washington, don't pay an income tax, and shop in Oregon and don't pay a sales tax. Although be careful, I hear you can't do it too much. States know how to get their revenues when they need it, from what I hear. Next, we need to talk about the distributional effect of taxes. Some taxes are regressive, while other taxes are progressive. A progressive tax is like the income tax. So this has nothing to do with politics, like progressive and conservative and things. No. It's an economic term. It simply means that the rich pay a higher share of their income. And you can see it. It's right baked into the income tax. The wealthier you are, the higher percent you pay. Some taxes are regressive, the opposite. To get an idea, let's talk about this grocery budget here. A lot of information on this graph. In the vertical axis, we have share of income. Share of income that groceries adds towards income. On the horizontal axis, we have the actual dollar amount that people spend on groceries. And each dot represents an income decile. So number 1 means the bottom 10%, or bottom 20% for the second one. And then the 10th is the top 10%, the richest 10%, and everybody in between. The richer you are, the more you spend on groceries. Instead of shopping at a discount grocery store, you're going to go to Whole Foods or some other nice place. We also notice that the richer you are, the lower you are on the vertical, the smaller component your groceries are to your overall income. Now, this is important. So if we tax all spending the same, so sales tax is a constant, 7%, 8%. 7% of 40% of your income is very different than 7% of just 3% of your income. So sales taxes, we find, are regressive. The rich pay a lower share of their income. Overall, the tax code is progressive. Capital taxes, income taxes, property taxes are all progressive. But sales taxes are regressive. Social Security taxes are regressive. The rich pay a smaller percent of their income on these taxes compared to the poor. The last component of government budgets are these things called tax expenditures. I know it's a funny little word. This thing matters. Like a form of spending that's actually a tax break. So it doesn't show up in the spending data, doesn't show up in the tax data, but it has huge implications for the economic burden of taxation. We have words for this like the deductions, exemptions, and credits that lower your tax obligation. It is very similar to government spending, it just shows up differently in the books. But like I said, the economics of it certainly matter just as much. And they are usually regressive. They place a heavier burden on the poor. Why? Because rich people pay more in taxes, so tax breaks are going to matter more to them. If you don't have to pay taxes or you have to pay very little taxes, a tax break isn't going to affect you if you don't have any taxes to pay in the first place. So this benefits is a way to reduce the taxes for the wealthy. And here's a list of many of the different tax expenditures. We're going to divide it up by income quintile. So the darkest red is the top quintile, the fifth quintile, the top 20%. And then we go down to the bottom 20% in the very light, the first quintile. And we see things like there's a tax break for putting money in your retirement account, and that benefits the wealthy a lot. We are spending hundreds of billions of dollars every year on that tax break. There's an exclusion for employment-based health insurance. Now that's fine if you have health insurance with your employer. Economists don't love this. We think it'd be more efficient if the health market was entirely different from the labor market. But as we see, the majority of that benefit again goes to the top 20, the top 40%. And very little of that goes towards the bottom 40%, in part because they're less likely to have health insurance associated with their work. Preferential tax rate on capital gains, that's just the top 20%. Now, some of these, like the child tax credit, the earned income tax credit, or the health premium tax credit, those are a little more equitable. The child tax credit's more equitable. And the earned income tax credit, that one's targeted towards lower incomes. And we're spending around $70 billion a year on that. But keep going down. Charitable deductions, just for rich people. Qualified business income deduction, just for the wealthy. I want to focus a little bit more on that mortgage interest deduction. That's the one from the second from the bottom. This is a program that in name is there to help people afford housing, because your interest you pay on your mortgage becomes tax deductible. But because of the standard deduction, remember the standard deduction is $14,000 a year if you're single, it's double that if you're married, you'd have to spend more than $28,000 a year just in mortgage insurance. You know who's paying more than $28,000 a year in mortgage insurance? The top 20%. I've never have. Anybody in the middle hasn't, and especially anybody at the bottom. So this does nothing to help with housing affordability because the top 20% can afford houses regardless of this. This is a $30 billion, $40 billion annual program. This is bigger than the budget for NASA, yet it's just a subsidy for folks for their first home, and it even applies to a second home. So it's a subsidy for rich people to own a vacation home, to own larger homes. I mean, economists across the board are pretty much like, yeah, we need to get rid of this thing. If we add all of these up across income distribution, we find that well over $500 billion a year in tax breaks are going to the top 20%. Tax exemptions, deductions, and credits overwhelmingly benefit the wealthy. There's going to be a lot of debate over the next decade on how to lower the government deficit. Tax expenditures are big. Add them all up, it's $1.2 trillion in 2019. That was kind of the most recent CBO data they had there, the Congressional Budget Office. For reference, the deficit, the most recent number we have is for 2023, is $1.7 trillion. Without touching taxes or spending, one can nearly eliminate the deficit just by cutting these tax breaks for the wealthy.